Impermanent loss can turn a profitable venture into a financial headache. Imagine losing money even when the market is rising. Sounds confusing? Let's break it down. In decentralized finance, or DeFi, impermanent loss occurs when you provide liquidity to a trading pair in a liquidity pool. When you do this, you deposit two different assets into the pool. As trades happen, the value of those assets can fluctuate. If one asset rises significantly in price compared to the other, you may find your holdings worth less than if you had simply held onto them. This loss isn't permanent, but it can feel that way when you're staring at your portfolio. Let's illustrate with a simple example. Suppose you add $1,000 worth of Ethereum and $1,000 worth of DAI to a liquidity pool. That's a total of $2,000. Over time, Ethereum's price skyrockets, doubling in value to $2,000. Meanwhile, DI remains stable at $1,000. Now, if traders use the pool, they will buy Ethereum and sell DI. The pool automatically balances the assets, selling off some Ethereum to maintain the ratio. When you withdraw your funds, you might find you only have $1,500 worth of assets, $1, $500 in Ethereum, and $1,000 in DI, despite the fact that Ethereum alone is worth $2,000 if you had held it. That's the essence of impermanent loss. It happens because liquidity pools operate on an automated market-making system. The liquidity you provide is constantly being adjusted based on supply and demand. This can lead to situations where, even though the price of one asset rises, the overall value you receive when you withdraw is lower than if you'd held the assets separately. Now, let's dive deeper into why this matters. Many DeFi projects entice users with high returns for providing liquidity, but it's crucial to understand the risks involved, like impermanent loss. If you're considering supplying liquidity, think about how volatile the assets are. The more volatile an asset, the greater the risk of impermanent loss. But don't be discouraged. There are strategies to mitigate this risk. Stablecoin pairs tend to experience less impermanent loss because their values don't fluctuate wildly. In some cases, yield farming protocols offer incentives or rewards to offset potential losses. It's all about balancing the potential gains against the risks. So, what's the takeaway? Impermanent loss is a real risk in DeFi, but it doesn't have to be a deal breaker. Knowledge is your best tool. Understand the mechanics of liquidity pools, assess the volatility of the assets involved, and consider your risk tolerance. With the right approach, you can navigate the world of DeFi effectively. Remember, every investment carries risk, but being informed can lead to smarter decisions. The world of DeFi is filled with opportunities, but don't forget to protect your investments.